Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 4 o'clock in New York on Thursday, April 14th, 2016, and this is the Daily Report for Gold and Silver. We do have a continuation of the sell-off that began yesterday. Precious metals complex as a whole trading under pressure. Gold trading off about 1.3% on the day, off about $17 when we look at spot, trading at $12.25. The low 12.25s. The low today, 12.24 and change. The high on the day, 12.41 and change. So as you can see, we're just ticks off of the lows. Of course, we did have a trade that was active up until yesterday night, last night trading, or this morning, depending on where you live, in which we got in at 12.40. We moved our stops up to just below 12.40, but I came out yesterday suggesting that we loosen that stop and make sure it's around 36. So we're marking ourselves in at 12.40, out at 36 for a $4 loss on the trade. On today's report, we need to look at where support could be found in this market and whether or not this most recent downside move, we've seen $20 2 days in a row, almost a $40 decline in price, whether we were noticing any long-term damage on the charts. We'll talk about those things all on today's daily report. So traders, obviously the big question is whether or not today's move has caused any kind of long-term damage as we look at the charts. So traders, first, a recap of the trade that we just were stopped out of. We did take a loss of about $4, a very, very tight stop loss that we implemented as we moved that up the other day. And even though we loosened it to about 36, we could have kept it at 39. In hindsight, that would have been better. The drawdown would have been $1 rather than $4. But we've still kept our losses within what I believe to be really acceptable levels. It's all about risk reward. We're certainly not going to hit every trade in terms of profitability, but if we can keep the winners outperforming the losers in terms of percentage gains and percentage drawdowns, even if we're doing 50%, which we're not, but even if we're doing 50%, we're going to come out with a really good profit at the end of the year, and that, of course, is what I strive for. Looking at a 480-minute chart, we noticed that there was some sort of resistance. It really came in this market roughly at about 2060. A three-river evening star was identified on our daily charts, but really, in terms of long-term damage in the chart, and that's what we're trying to assess right now, as long as we're maintaining above 1215, and then there is another level at about 1206 that we'll look at on the next chart we pull up, I think that we have not sustained any long-term damage. However, I am noticing something that's a key distinction from the way that we have seen these markets move in the past. And to illustrate that, I've pulled up this chart being a daily chart, but it's in Japanese average format. And the Japanese average format really will make it clear to us just how much of a congestion area we are currently in as this market trades roughly above 1200 at 1227. Now, what I mean by this congestion area is a defined correction in the market when we look at a Japanese average, a Heikin-Ashi, can really be characterized by consecutive red days down. And even if the market closed higher on the day, it's comparing it to the midpoint. And that's why you smooth out this curve, so to speak. You can also look at bottom or top action consolidation in the market as really alternating color. So here, look, the body sizes begin to get very, very small. You then get these lower tails on a green candle or upper tails on a red candle, and that's what you look for in terms of a market trend that's kind of waning or falling apart. You look for those tails on a market that's moving strongly, such as this uptrend right here. What we're looking for is that absence of lower wicks on the way up, and we're looking for an increase in body size, or I should just say strong body size. You certainly see that right in here throughout here as this market broke past this former top at around 1103, 1104, and then moved up as high as 1280. It was a tremendous rally in the market. And now if we look at the candles, we did have a couple of very strong days, and that's really what triggered or partially what triggered the buy signal itself. We got this doji when we look at yesterday. We definitely have this down day today. Again, this doji is because it compares it to the midpoint of the prior candle. If we convert that into a standard candlestick chart, let's go ahead and do that now. Then you can really see in terms of the true opens and true closes. And you can also see the candlestick pattern that we identified the other day, that Three River Evening Star. And I was concerned about that, especially with the doji gapped in the center of it. And it was one of the reasons we tightened that stop up. But at the same time, unless this market breaks below, and as we said, there's a couple of areas, one being roughly in the 1215 area, that's right here, and it's based upon these lows that come in here, and then this low here. Also, the fact that this low here at around 1205 comes in not only as a low in the market, but as a 38% retracement. It is a retracement of this extended move that we're labeling as a wave 3. So for that reason, as long as we're remaining above this particular price point, that tells me we have not seen long-term damage in the charts. And with that in mind, I want to take one quick look at dollar strength or weakness to see how that did affect the market today. If you recall from yesterday's trading, we had a $13 drop in the market. Out of that 13, $10 was due directly to dollar strength. Now, dollar is nominally higher on the day, and I mean nominally higher because when we look at the Kitco Gold Index, which I have just pulled up, and we look at the current drawdown down about, $16, you can see that on this particular table that it isn't dollar strength. Dollar strength is definitely decreasing the value of gold, but only by about $2 per ounce. It is predominantly selling that's coming into the market, and that's accounting for $14.50 of the $16.50 drawdown. So we are looking at predominant selling in the market. And once again, I don't believe we have seen long-term damage in the charts. We'll have to let the dust settle here, and then we'll go from there. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.